Thank you for meeting with me today. I've been going through the basics of reinsurance and came across the term treaty reinsurance. Could you explain what it means in detail?
Of course. Treaty reinsurance is a fundamental concept in the reinsurance world, and it's important to understand how it works. In simple terms, treaty reinsurance is an agreement between an insurer and a reinsurer where the reinsurer agrees to automatically cover a specific portfolio of risks.
So, instead of negotiating each individual policy, the reinsurer agrees to cover an entire portfolio?
Exactly. That's one of the key advantages of treaty reinsurance. Once the agreement is in place, the reinsurer automatically takes on all risks within the agreed-upon scope, without reviewing each individual policy. This makes the process more efficient for both the primary insurer and the reinsurer.
That sounds efficient. But how does the reinsurer manage the risks when they're not assessing individual policies?
The reinsurer relies on the underwriting expertise and consistency of the primary insurer. Before a treaty is put in place, the reinsurer will carefully assess the insurer's underwriting processes, loss history, and portfolio performance. The terms of the treaty will be based on this analysis.
So the primary insurer is responsible for ensuring that the policies they underwrite fit within the treaty's guidelines?
Exactly. The primary insurer has to adhere to the agreed terms. If they underwrite risks that fall outside those terms, they may not be covered by the treaty, and they would bear the full risk themselves.
That makes sense. But what types of risks or policies are typically included in treaty reinsurance?
Treaty reinsurance is most commonly used for lines of business with a high volume of similar risks, such as property insurance, auto insurance, or casualty insurance. Because of the standardized nature of these risks, it makes sense to bundle them under a treaty.
It sounds like treaty reinsurance is ideal for large portfolios of fairly standard risks. But are there any limitations to using treaty reinsurance?
Yes, there are a few. While treaty reinsurance offers efficiency, it also comes with a degree of inflexibility. Because the reinsurer automatically covers all risks within the treaty, they don't have the opportunity to assess each risk individually. This can lead to some uncertainty on the reinsurer's side, particularly if the portfolio includes risks that could be more volatile than expected.